Okay, well, we're going to go ahead and get started. We've got a lot of slides to go through, and there will be some people joining us as we go. So, first off, thanks for joining us. I know that for a lot of people, talking about taxes is probably second only to going to the dentist as far as the pain factor on that. So, appreciate you joining me at your lunchtime to talk about taxes. Even though talking about taxes is painful, saving money over our lifetime, I think that's why most people are interested in this topic. So first off, we are recording this, and so we'll be sharing this out probably on YouTube later in probably next week. But as you are watching this, it would help me to help you if you sort of maybe jot down some concepts that you want some clarification on, maybe some questions about how you could personally apply some of these concepts to your situation. Definitely share any aha moments with me. I love to hear back from people about something they learned that really resonated with them or was very helpful. That helps me to know sort of the content for future webinars and information that's helpful to other people. And then, of course, any other tax planning topics that you'd like more information on. Depending on how this webinar goes, possibly have some more webinars in the future. Those would probably be a little less general and probably start to dive into some more specific things. But at the end of this presentation, I'm going to have a slide that's going to have a QR code on it. If you want to scan that, that's an opportunity to set up a phone call or a meeting with me to go over your questions. It will also have my email address, so feel free to send me an email with any kind of questions that come up during this presentation. Okay, so let's talk about HFG Trust and how we approach tax planning. So HFG is the largest locally owned wealth management and financial planning firm here in the Tri-Cities. And so we like to take a very holistic approach at our financial planning. So this diagram sort of shows tax planning at the center of all of that. Tax planning is not the center of financial planning, but it does impact decisions in all these other different areas that we touch on as advisors here. And so our goal is to help our clients meet their goals and also reduce their lifetime taxes when possible. In this webinar, I'm going to touch on two of the different financial planning topics that I've listed there: investment management, and then sort of just the on-track retirement planning, preparing for retirement. But there's really several others that I think are worth discussing. Again, they're a little more detailed. So, as I get feedback on some of these, potentially put out another webinar in the future. But some of these would be charitable giving, estate planning, certainly, legacy planning, for some, planning for college costs, and then for others, Social Security planning, when to collect, what are the strategies for that. So for me personally, why do I emphasize tax planning? Well, I've got 35 years of tax preparation experience as a CPA, but even more importantly, over the last 10 years, I've combined my CPA knowledge with the certified financial planner mindset. And what that has taught me is that tax preparation is not the same as tax planning. So let's look at the two. Tax preparation is looking backward, primarily looking at the prior calendar year, whereas tax planning is looking forward, and it's not just 1 year, as we'll discuss. It could be many years. Tax preparation is really about a single year. It's about last year, whereas tax planning, we're talking about your lifetime and even beyond. Tax preparation is about compliance, the forms, the rules. Tax planning is really about strategy. Tax preparation is very standardized. Pretty much the same rules apply to everybody. The same forms get applied to everyone. But tax planning is unique to your circumstances. So effective tax planning is not necessarily about paying the least amount of taxes in your lifetime. I know that would seem to be sort of what tax planning is about, but that's not really the goal. You don't want to make financial decisions based solely on taxation. For example, charitable giving. You give charitably because you want to give charitably, but then you make decisions on how you do that based on tax consequences and potential tax benefits. So achieving your financial goals, that's really the number one thing. We want our clients to achieve their financial goals, but we want them to do it in a more tax efficient manner. And that's the goal of effective tax planning. So first determine your lifetime goals, then look for ways to pay less tax on the path to achieving those goals. The key to tax planning is bracketology. Now, when I say bracketology, a lot of people imagine this bracketology, which is sort of the NCAA basketball tournament brackets. I'm not talking about that. I'm talking about the income tax brackets. Not nearly as exciting, but actually more important to you in the long run. So first, we want to determine what are your current tax brackets? Where are you at in the tax brackets where each additional dollar that you earn or that's taxed, what percent are you going to be paying on that? Then let's look at what are your future tax brackets? Are they going to be higher? Are they going to be lower? Are they going to be the same? So it could be next year. Maybe even more importantly, what about the rest of your career? And then into retirement. And then even after you're dead. And that surprises some people because they think, well, what do I care? Well, there's people that are going to be inheriting your estate from you, and they're taxpayers as well. So they may be in a totally different tax bracket than you are when they inherit some wealth from you. So I'm going to get into the weeds a little bit here, but hang in there with me because there is a purpose for all of this. So I'm going to talk about two different types of tax brackets. I'm going to talk about ordinary income tax brackets, and I'm going to talk about capital gains tax brackets. So I'm showing you the ordinary income brackets here. And on the left-hand side, I'm showing you the married filing jointly brackets for these. And this is for couples under age 65. And then I'm showing you the single filers over on the right-hand side. And again, these are under age 65. And that's because with the recent changes in the tax code, for those who are 65 and over, they actually get a little bit of a bump up in the 0%, what I'm calling the 0% bracket. So ordinary income, we've got a 0% bracket. There really is no 0% bracket, but you get a standard deduction that essentially takes some of your income and doesn't tax you on it. Then as your income goes up, starts to go into the 10%, 12%, all the way up to the 37% bracket, which is the red section at the top there. Now, I've got a note on the right-hand side that there's also a net investment income tax that could add another 3.8% on certain types of income once an individual's or a married couple's taxable income exceeds certain numbers there. That's getting into the weeds. I wouldn't necessarily worry about that, but I do want you to be aware. Okay, so what is ordinary income? What gets taxed as ordinary income subject to those brackets I just showed you? Well, typically wages and bonuses, self-employment income, interest from bank accounts, certain types of dividends, and these would typically be dividends outside of a retirement account. So this would just be an investment account, and these would be non-stock dividends. So this would be on bond funds or bonds that you hold in an investment account. And then also in that investment account, outside of retirement, you'll have some gains, hopefully over time in the investments there. And when you sell those, if you have owned that investment, that fund, for less than a year, that gain is also going to be taxed as ordinary income. And we'll talk about that a little bit more. Distributions from pre-tax retirement accounts. So think traditional IRAs, traditional 401ks, not Roths. Okay, so distributions from those accounts in retirement, that's going to be taxed as ordinary income. Any kind of monthly pension or annuity you have, taxed as ordinary. And also Social Security. So once you start collecting Social Security, depending on how much other income you have, up to 85% of that Social Security could be taxed as ordinary income. Okay, let's talk about the other tax brackets. These are the long-term capital gains brackets. And you can see there's a lot of green on this because they're much more friendly than ordinary income. So again, married, filing jointly on the left, single on the right. And this actually does have a 0% bracket at the bottom. And I've also included the standard deduction there. So you can see you can actually have quite a bit of long-term capital gains and not pay any tax on it if that's all you had. And I'll give you an example later to show why that applies. But you start moving up in this bracket, and 15% is the majority of people will pay 15% on their long-term capital gains. 20%, that's on the really high end. And again, the net investment tax could apply. Okay, so what qualifies as long-term capital gains? Well, as the name of long-term capital gains applies, long-term is more than 1 year, and it's capital gains. So again, we're talking about investments or property, assets that you hold outside of a retirement account that you have held, meaning you bought them and then sold them at least 365 days apart, and they went up in value. So just the gain on during that time that you held it. So typically stocks and bonds, mutual funds or ETFs, again, could be investment property like land or a rental or a business, could even be gold, silver, crypto, other investments, again, held for more than 1 year outside of a retirement account. Also, there's something called qualified dividends, and that's typically from stocks and stock funds held outside of a retirement account. They are generating some dividends typically annually during the year, and those qualified dividends actually get taxed at the long-term capital gains rate. So again, getting in the weeds, but hang in there with me. It's going to get better. All right, let's look at an example, and this will help you sort of visualize what I'm talking about. So I've got a married couple. So both sides, left and right, are now for a married couple under age 65, right? The circumstances here, they're doing well. They've got $450,000 of income. 300 of that is taxable wages, 25,000 in short-term capital gains. So they held something for less than a year outside of a retirement account. 20,000 in ordinary dividends. So that's going to be from bond funds in that same account. 30,000 in qualified dividends. So they had some stocks or stock funds in their investment account that generated dividends. And they also had some long-term capital gains. They sold some holdings in that account that they had held for more than a year. So let's see how this stacks up. Let's start with the ordinary income over on the left-hand side. So we've got their wages, short-term capital gains, ordinary dividends. You see, if that's all they had, they'd already be paying 10% on some of it, 12% on some, all the way up to 24% on some of that income. Now let's look at the qualified dividends and the long-term capital gains. Those actually get stacked on top of the prior income. So they don't get to go down to the 0% bracket with those, unfortunately. They are up on top, but again, 15% on those is much better than paying 24% on the left-hand side. So looking at this example, if some of those ordinary dividends could have been qualified, that would have saved them 9% tax. If their short-term capital gains, if they just held those investments a little longer to make it past 1 year, that would have saved them 9% tax on that as well. And that's why it's important to understand the difference between ordinary and long-term capital gains. Okay, so let's talk about the history of tax brackets. So I've got that on the screen here. And this only goes back to 1970, but that was sort of a high point. There were higher points, but that was pretty high. And then over on the right-hand side, you can see 2025. So red line at the top, that's the highest tax bracket. So back in 1970, it was as high as 70%. And now we're looking at 37% in today's rates. Gives you an upper mid bracket, a middle bracket, and then the lowest bracket. Again, you can see all the way across the board, no matter which bracket you're in, it was much higher in the past, and we are in what many would argue is a historically low tax bracket scenario right now. Even though it doesn't always feel like it, the point here is that I don't anticipate that tax brackets are going to go down in the future. I think it's more likely that they will remain the same for a while and eventually go up. And that's because we need to fund healthcare, we need to fund defense, that we just need to fund so much of what's costs money in our government that at some point their taxes are probably going to go up. I can't say how much and I can't say when. I just feel that odds are rates will go up in the future. And again, that goes back to bracketology and knowing where you're at currently and then estimating where you think you might be in the future. So again, first determine current tax brackets, then estimate future brackets. Now, once you sort of have that sense of where you're at and where you think you're going tax-wise, you either defer taxable income into the future if you think you're going to be in a lower bracket in the future, or you might even accelerate taxable income into current years and pay tax on it now so that you can avoid paying a higher tax in the future. The first one, deferring, I think most people get that, kick the can down the road, avoid paying tax now, even if it means paying tax in the future. But for some, really, you actually want to go ahead and pay the tax now. And so that's what tax planning and tax analysis is going to tell you. Additionally, you can find options that avoid taxes altogether. And I put legally there because I'm not talking about not reporting income. I'm not talking about anything that's illegal. I'm saying there are ways where you can actually avoid taxes. So I'm going to give an example, a HSA, a health savings account. If you have an opportunity at your employer to participate in an HSA account, that's a great way to completely avoid taxes, and not just income tax, but depending on where you're at in your total taxable income, you might even be able to avoid some payroll tax. That's just a double bonus. And that is money that, yes, it's locked up in a health savings account. You have to use it for certain purposes to pay for health care costs and other things. But it does avoid taxes. And so really high on the HSA plan options. So let's talk about saving for retirement. We're going to take a little bit of a pivot here. So you're saying, okay, great, tax, how do I even start saving for retirement? Where should I focus my energies on that? So first off, I would encourage you, if you are part of a working where they have a 401k, 403b, some kind of plan where your employer will give you a certain match. If you contribute some of your own money to the retirement plan, they'll match. Make sure you're contributing enough to at least get the full employer match. It is part of your compensation that you will not get unless you participate. So that's step one. Okay, you've got that done. Great. What now? Okay, again, HSA plan. If your employer offers an HSA plan and if you qualify to contribute to it, that would be my next option for excess savings that you have available. Contribute to that HSA. Again, it is tax avoidance. It's not just tax deferral. It's a great way to save money. All right, moving on. Okay, now you get to the next step. Well, if you can go out and open a Roth IRA outside of your employer's plan, I would say that would be next step. The reason why I would say outside the employer plan with a Roth IRA is that you have much more flexibility with that Roth IRA outside the plan. And it also acts for many as sort of a savings bucket for maybe education costs, maybe first home purchase, anything out there that they want to save money for. Ideally, as an advisor, I'd like to see you save it for retirement and leave it there and let it go to retirement because it's all tax-free growth in that account. But the money you stick into a Roth IRA, you can actually pull that money back out at any point without penalty, without paying any tax on it. You have to leave the earnings on the holdings within that Roth. You have to leave earnings in the account all the way to age 59 and a half. And there's a few exceptions to pull it out early, but primarily earnings have to stay in, but your contributions can come out at any point. So much more flexible than your employer's plan. Okay, so you've done that or you unable to, well, let's go back to the Roth IRA. So current limits, you can contribute up to $7,000 a year. 8,000 if you're like me and you're over 50. Married filing jointly, it does start to limit your ability to contribute to an account like this if you have high income. So if you're married and you've got taxable income of over 236,000, starts to limit, and eventually you can't contribute any. For singles, that starts at 150,000, so you need to be aware of your other taxable income before you contribute to a Roth. And you have to have earned income, or your spouse has to have earned income. So if you're in retirement and you're on pension and Social Security, you don't have wages or other earned income, then you cannot contribute to a Roth. Okay, so moving beyond the Roth, what now? You're doing really well, your earnings are high, you want to be socking it away for retirement. All right, now go back to your employer's plan and contribute more to that plan until you hit the IRS maximum. And if you're able to do that, that's great. Then at that point, you can pivot out and maybe put money into other investments, a non-retirement account outside of your retirement account plans. Maybe you invest in property, maybe in a rental, something that's going to provide some long-term growth. Okay, we're going through these things really fast. Again, take notes, send me any questions you have. Happy to answer those. So let's talk about how much to save. Well, as much as possible, right? That's the easy answer. I know that's easier said than done. But I would encourage you, especially if you're early in your career, to build a habit of saving and build a habit of increasing your saving as your salary goes up. So let's say you get a 6% bonus in a year. Rather than just keeping the same percent contributed to your 401k plan, take 3% of that, take half of your raise and add 3% to your savings every month into the 401k. Sort of stretch yourself. Keep your standard of living at a decent level, a good level, but as you start to get more income, shovel more into the retirement accounts. So here are the maximums for the 401ks currently. If you're under age 50, you can contribute of your money $23,500 this year. And then you're also probably going to get some kind of match from your employer. So that's great. And you'll definitely get the full match because you're way above their limits. If you're age 50 or older like me, 31,000 this year. And there's actually the small age group. If you're in 60 to 63 age range, you get another, what is it, 3,750 you can contribute this year if you want to get really aggressive. Okay, so you're contributing to your employer plan, 401k, 403b, and they offer pre-tax and they offer Roth. And you're wondering, okay, what do I do here? So here's some general guidelines on that. Goes back to bracketology, right? If you're currently in the 10, 12% tax bracket, by all means, contribute on Roth basis. You won't get any tax break. You're going to pay tax on the income you earn, and then you're going to be putting after-tax dollars into the Roth. But it is highly likely that you will be in a higher tax bracket in the future. And so every dollar that goes into that Roth account is not going to get taxed in the future. All the growth in that account, no tax in the future. All right, so now you're sort of in the middle ground. You know, you're in the 22 to 24% bracket. I still like the Roth option, but if you do feel like you want to get some tax relief from your contributions, so if you put into a pre-tax 401k or retirement account, you actually get to deduct that from your taxable income in the current year, right? You're not going to pay tax on that money. But down the road in retirement, when you take it out, we talked about this, it's 100% ordinary income. So even though it's invested in stocks and bond funds inside your retirement account, all the earnings in there are eventually going to come out as ordinary income in the future, and you're going to pay a pretty good tax on that. So I'm a little bit indifferent in this area. I prefer the Roth, but you could also do half and half. You know, you could split it. Most employers will allow you to do that. Okay, let's say you're doing really well, salary is really high, you're in the 32% tax bracket or above. I would say go ahead and contribute on a pre-tax basis. Get the tax break now. You might be in that bracket in the future in retirement. Good for you if you are. I'd say a lot of people are going to drop down in their taxable income in retirement. And so there's a good chance you're going to be in a similar or lower bracket in the future. Might as well go ahead and take the tax benefit now. All right, let's pivot again. We're going to talk about portfolio allocation. And again, these are some general guidelines. So for younger employees, new in their career, again, probably in those lower tax brackets, but younger, that's the primary thing. You've got a lot of career ahead of you. Go ahead and be pretty aggressive in your allocation to stock funds. You've got a lot of time for the markets to go through the ups and downs, and those stock funds have the highest potential long-term growth. So you should probably be fairly high stock to bond ratio, maybe in the 70 to 30, 80 to 20 range. Now you're getting through your career and you're starting to get towards retirement. Okay, maybe you start to shift out of the stock side and into the bond a little bit over time to sort of, the bonds are going to be less volatile, less risky year by year. And so you sort of start to dial in what your portfolio balance is going to be once you hit retirement. Okay, now you're retired or right at retirement. In general, again, most people are going to want to have a fairly balanced portfolio, about half in stocks, half in bonds, or maybe even more to the bond side. And it really depends on what other sources of income you're going to have in retirement. So if you've got really strong Social Security, you got a good pension, maybe you've got rental income or just inheritance or something out there, you really aren't going to tap into the retirement account, then you can probably be more aggressive with that account, because odds are it's just going to be inherited by your kids or somebody younger than you anyhow. So it's okay to have a little more risk on that portfolio. Target date funds. So you're looking at your 401k plan and it's got 30 different funds you can invest in, and it's just like, well, I don't know where to start. I don't feel comfortable making my own decisions there. Almost all retirement plans are going to offer what are called target date funds, and that is the easiest way to invest in a very diversified portfolio. So it's got a good mix of stocks. It's going to have US stocks and non-US stocks, and it's going to have bonds in there. Just a really diversified portfolio. It's going to automatically shift from stocks to bonds over time. So typically, you'll look at a target date fund and you'll kind of look at your own situation. Let's say I thought, okay, I'm probably going to retire around the year 2040, right? Then you go out and you would pick the 2040 target date fund, and it would sort of, based on historical returns and averages of people sort of in your age range or career space, they would say, all right, we think probably a 70-30 allocation of stock to bond is right for you, something like that. And over time, as you get older and you get closer to your retirement, they start to shift out of the stocks and into the bonds, right? Which is what we talked about earlier. This is from Vanguard, and this kind of just shows the stock to bond allocation of their target date funds over time, stocks being the green side and the bonds being the yellow. So you can see that it just automatically starts to dial down the risk and the exposure to the stock market as you get older and as you get closer to retirement. So you really only have to pick one fund in that case. Very convenient. Okay, so let's talk about advanced portfolio allocation. And again, this is going to get into the weeds and may not apply to everybody, but it's important to know. And so in this case, I'm going to talk about having three different buckets, if you will, of investments. One in a pre-tax IRA or 401k, another in a Roth IRA or 401k, and then that third type of investment account that's not in a retirement account that we've talked about before. So where do you hold the bond funds? Well, you want those to be concentrated in the pre-tax accounts, the traditional IRA, the traditional 401k type accounts. And we'll talk about how that works. Well, they've got the lowest potential for long-term growth, right? All future draws are going to be taxed as ordinary income. And with bond funds, even if you had those outside of a retirement account, that's going to be ordinary income to you anyhow. So it's okay that they stay in this account that's going to be taxed as ordinary income in the future. That makes sense. What about US stock funds? Well, I recommend you concentrate those in the after-tax accounts. Again, we're talking retirement accounts. So the Roth 401k and the Roth IRA. These have a high potential for long-term growth, right? And so in that Roth type account, all that growth is going to be tax-free in the future. There's going to be no tax owed by you and no tax owed by anyone who inherits that account from you. Then if you've sort of filled up that account with your US stock funds and you've got some excess, okay, now add some US stock funds out to that taxable non-retirement account. And again, I'm going to show you an example of this. I know this is getting pretty complicated. Let's talk about the non-US stock funds. And this is sort of an aha moment for me about a year ago. I recommend you actually concentrate those funds in that non-retirement account. And again, we've got 3 different accounts in this scenario. So we've got opportunity to invest certain funds outside of a retirement account entirely. Here's why. Well, if you hold those funds for at least a year, same with the US stock funds, then you're going to get the long-term capital gains rate out there when you sell them. And they generate qualified dividends, also taxed as long-term capital gains. We talked about those being better than ordinary income. Here's the kicker, though. Non-stock funds or international stocks, individual stocks, generally there's going to be some foreign taxes paid by those funds no matter what account you hold them in. And if they're sitting in a retirement account, either a traditional IRA or a Roth IRA, those taxes get paid and you get absolutely no benefit for it. If they're out in that non-retirement investment account, you actually get to deduct those taxes against your US tax. And I'm going to show you an example of this. So this is an actual client of mine. This individual has a target 60-40 portfolio, 60% out in the global stock market, 40% in bond funds. And there's a few more categories on here, but essentially that green and brown, the fixed income and the alternatives, that's the fixed income, that's the bond side of the portfolio. And then the blue, the red, and the orange and a little bit of purple, those are more the stock side of the portfolio. So real practical, what I just sort of gave you in theory, I'm going to show you what we've done with this individual's total portfolio. So again, we're managing the entire portfolio to a 60-40, but this individual has 3 accounts. The total portfolio is about $1 million, and each of those accounts is roughly 1/3 of that total value. So we're targeting what's on the left there, but each of those other accounts is going to have an entirely different look to them. This is what they look like. And you can see the pre-tax account is mostly the bonds and alternatives, the bond and bond-like returning investments. So we've loaded those up in that pre-tax account, just like I told you before. In the Roth, high allocation of stocks. That's that US stocks. That's that blue piece of the pie there. It's got a little bit of bond funds because we had some left over we needed to put somewhere. And it's got some emerging markets, which is international, but those typically don't have as much taxes that come out of them. The taxable account below at the bottom, that's not a retirement account, right? And it does have quite a bit of US stock in there because they've got a lot of US stock in their portfolio. So we had to put it someplace. But you'll notice that all of that international developed non-US stock, that red piece of the pie, is sitting right there. And here's why. So it's been a really good year so far for this individual, and his portfolio overall has generated 13.2% after our fees. I mean, just a fantastic year. Again, not going to happen all the time, certainly not promising these types of returns, but this is a true return on this portfolio. Now, 13.2 on the total portfolio, fantastic, but let's see what each of the individual accounts have returned. So the pre-tax account, remember the one that we don't want to grow as fast as the others. That's where we want to put the low growing, the type of funds that are going to generate ordinary income. That's in that top one, 5.9%. Still a good return, right? But then you drop down to that Roth account. That's where we want the most aggressive long-term growth, up 24.6% for the year. And then that taxable account down below, also good. It's got a lot of stock in it. It's got US, it's got international, 16.5%. Again, total average of all those in the portfolio, 13.2. And as I mentioned on that non-US stock, here's the deal. That's why it's in that taxable account. It's also, and this is prior year, 2024, but last year, those holdings generated $226 of foreign tax credit that this individual got to take on their return, dollar for dollar offset against US tax because they're sitting in this account. If these non-US funds had been in any of the pre-tax or the Roth account, still would have paid those $226 in foreign taxes, but would not have received any tax benefit. And so this is the importance of allocating your different types of holdings into different accounts. Okay, so that doesn't apply to everybody. And you're saying, well, that's great. I don't have a Roth, an IRA, and an individual investment account. Okay, well, what if you only have two types of retirement accounts? You've got the pre-tax and the Roth. What's the allocation strategy there? Again, pre-tax, that 401k or IRA, go ahead and put as much of the bond funds in there as you can, and then top it off with the stock funds after that. Whereas your Roth account, you want to go real heavy on the stock funds. US international stock funds go into the Roth first, and then if you've got excess bond funds, go ahead and put them in there. But that would be sort of the overall allocation. Well, what if you're not selecting different stock and bond funds? You like the target date fund idea, right? It's really easy. Well, you could actually hold two different target dates in your portfolio overall. And you could put a more conservative target date fund into the pre-tax 401k. And you could put a more aggressive target date fund in the Roth. And that would look like, say, a 2030 fund in the pre-tax and a 2045 or 2050 fund in the Roth, because those are going to have a different allocation to bonds and stocks. Again, be more aggressive if you're going to have money in the Roth account, be more conservative in the pre-tax. Okay, we're going to just pause, take a breath here. We're going to review some key takeaways so far, and then I'm going to pivot one more time. Again, tax preparation, not the same as tax planning. Focus on the bracketology, where you're at now, where you're going to be in the future. Determine your financial goals first. It's not just about saving taxes. It's about meeting your financial goals and then figuring out ways to get there that also save on lifetime taxes. Tax planning is forward-looking. It's about your lifetime and even beyond as far as taxes go. It's unique to your circumstances. So even all the information I've given you here, it's for education purposes only. You may be able to apply some of it very easily to your personal circumstances, but you really want to be careful and make sure you understand what you're doing there, because this is general information. Okay, this is the last pivot. And so I want to talk about the timing of tax planning, because we all hit different phases in life where tax planning has different opportunities involved. And I want to highlight some to sort of give you those aha moments in your life where you say, okay, either I'm headed towards one of these, or I might be in one right now, and I should be looking at some serious tax planning opportunities. Sometimes it's just a significant change in income, right? You start a new job and you have a higher income. You lose a job, right? Or something happens and your hours get cut and your income goes down. Those types of changes sort of present some, I'm going to say, tax planning opportunities, but also tax planning challenges. That's just a good time to get some tax planning done. Retirement or sale of a business. That seems pretty obvious, but a lot of people don't necessarily maybe take their planning to the level they should right around these transitions, because those are typically pretty big deal as far as change, again, sort of the change in income, right? Getting married or divorced. We looked at initially, early on, we looked at married filing jointly brackets versus single brackets. They're different, right? And so depending on getting married or divorced in a year, the year before, the year after, there may be some opportunities for tax planning. Moving to another state. You're probably aware, if you live in Washington State, we don't have a state income tax. If you grew up in Washington State and haven't been elsewhere, you may not realize that other states do have income tax. And if you are going to move from a state that has income tax to one that doesn't, or vice versa, that's a big deal. And I've over the last couple of years, I've had some really fantastic tax planning opportunities with a couple of my clients who moved to other states that have income tax. And we did talk about, it goes sort of back in some slides here about accelerating income. We did some serious acceleration of income through Roth conversions and some other things into the year, even the half a year when they lived in Washington State, so that they would not have to pay any tax on that in the future, both federal and state going forward, and save significant taxes. So that's a big one. Filing to collect Social Security or a pension, right? I've got some clients that are retiring this year. They have some options about when they start their pension. I've got clients who are considering starting Social Security. Both of those are pretty much, once you do it, you're locked in. And so that's going to start generating some taxable income. There may be cases where you want to go ahead and do it sooner. There may be cases where you actually want to wait a little while and do some other tax planning right before starting either of those. Death of a spouse. Unfortunately, I do have some clients who have had a spouse pass away this year, and it is a definite planning opportunity. It's a difficult time. Tax planning isn't the top of mind, and it shouldn't be for a while, but eventually as things start to settle out for the surviving spouse, they need to look at some tax planning. They need to get some help there because there are some real important opportunities there. Receiving an inheritance. Again, this year is just, I've had a little bit of everything. I've got several clients who have received an inheritance this year, and there's definitely been some tax planning opportunities around that. I wish I could go into one of them because it was just really unique, but it's so unique that it's not going to apply to hardly anybody out there, but it was a really fascinating opportunity, and we did some great stuff on that one. So again, this is the timing of tax planning. Just want you to be aware, sort of plant a seed in your head of different times, transitions in life where tax planning could be really important for you. Again, HFG, we look at tax planning holistically. We've got the highest number of certified financial planners here in the Tri-Cities. We are very holistic in our approach. Lots of different topics here. I've touched on 2 of them. There's others that I'd love to dive into on future webinars. Again, your feedback would be really appreciated if you would see value in those, or if you have questions on those. So that's 100 slides in 45 minutes. You survived. Hopefully you took some notes. Here's the QR code that I mentioned at the start. So if you want to get a hold of me and actually set up a time for a phone call or a meeting to sort of dive into some of these specific tax planning ideas and see how they apply to you or other financial planning topics, right? Well, let me go back to that. Well, I won't. Oh, I will. Okay. Anything else on this sort of wheel of different planning topics that you're interested in? Not specific to tax planning, just go ahead and get a hold of me. Use this QR code to set up a time. If you're not comfortable with that, no problem. There's my email, paul@hfgtrust.com. Feel free to send me an email, send me something through LinkedIn, however you can get a hold of me. And I'm happy to answer your questions as best I can. Or if I need more information, I'll get that. Or if it's something I can't answer, I'll say that as well, but I will definitely give you sort of some guidance on where to look. But I've given a lot of tax advice over the last 35 years. Love doing it. It's a passion of mine. So hopefully that's come across in this webinar. Again, I really would love some feedback from you on how you perceive that this webinar went, topics you'd be interested in, how we could do better going forward. And thank you so much for spending 50 minutes with me at your lunchtime on an October day. I really appreciate it and look forward to talking to you in the future. Thanks.